Welcome back. A down day for the markets. All three of the major averages ending in the red. Some heavy selling in the tech sector once again. As you can see, the NASDAQ closing off just over 3%. We want to break all of this down with our market panel. We have Brian Jacobsen, Allspring, a global investment senior investment strategist, and Marta Norton, Morningstar Investment Management America's chief investment officer. It's great to have both of you. Brian, let me start with you. In just the last at the top of the hour, we heard from St. Louis Fed President James Bullard, and he was asked, obviously, about that higher than expected or about that high inflation print that we got in April, the jump of 8.3%. He went on to say that inflation is broader, more persistent than many thought, that the Fed is going to have to act to keep inflation under control. But he didn't go as far as saying maybe a 75 basis point hike will be necessary. What do you think after seeing that print from April? Could the Fed or should the Fed be a little bit more aggressive?
You know, I think that the Fed actually has it well calibrated, just given the hand that they've sort of dealt themselves, right? I think that we can easily Monday morning quarterback what they should have done a year ago or a few months ago where they late to the game. But, if you kind of look at the all the policy statements from the Federal Reserve over the last year, they were very worried about the sustainability of the economic recovery. Every communication was about, the path of the recovery is going to follow the path of the virus. And so maybe they were overemphasizing the pandemic and not really appreciating that building inflationary pressures. But despite that, this path that they're on, 50 basis points for the next couple of meetings, seems pretty reasonable. The market has that priced in. For the balance of the year, if you have 5 meetings, 2 of them with 50 basis point moves, and then the next 3 with 25 basis point moves, that gets them slightly above what they think is the neutral rate. So I think that's a pretty moderate path. It's aggressive, but not overly aggressive for the markets necessarily.
Marta, the context is that it was less than a month ago that Bullard said we cannot rule out a 75-point hike, and arguably it's more widespread. Inflation has, maybe it's peaked, but certainly, as he acknowledged there, a bigger problem than they first realized. So how can he pivot from not ruling it out to now ruling it out when you could argue things are worse?
Right. I think that's a really important observation. And I think the consideration that needs to be top of mind for Fed and for investors and really for all of us is this idea that what we're trying to do is thread the needle. We want to pull inflation back, but we don't want to jeopardize the overall economy. We want to find that point where inflation is under control and we're balancing the needs for growth and for employment and the like. And so, whether the Fed should be more aggressive on that front, I think what holds their hand back is that this isn't a single variable exercise. This is where they're balancing multiple things. And I think that is slowing them down. Now, whether that means that they're taking the right approach by not being more aggressive, that remains to be seen. And I think that's what we saw from his comments. This is very much a real-time analysis, and there's room for optionality in terms of how the Fed behaves going forward.
And Brian, as we look at what is this convergence of a perfect storm, you have what the central bank needs to do to bring down inflation. You also have the Ukraine-Russia conflict. And of course, you have the slowdown in China due to a lot of these lockdowns, the zero tolerance policy on COVID. And you say in your notes that if any of those were to turn, we could see a turn in the markets. How soon, though, do you think we would see the ripple effects if, say, the conflict were to end very quickly? How soon would it take for that to ripple into U.S. market?
I think that would be almost immediate, right? And that's one of the problems with trying to position portfolios is if you try to react to the news, it's going to catch you off guard. So you really have to try to anticipate it. John Maynard Keynes famously said that successful investing is about anticipating the anticipations of others, right? So it's very much trying to anticipate when will these turn. Now, it's very difficult to predict when will the CPI numbers begin to show maybe the supply side improving so that begins to moderate so central bankers can tone down the rhetoric. When will the situation in Ukraine perhaps get better as opposed to get worse? When will China turn a corner with their zero COVID policy? I mean, I think we kind of saw that last night with how positive markets were when it was indicated that the Shanghai COVID numbers were down, right? The market's going to move very quickly. So I think that this type of drawdown, while it can be very difficult to go through, is a good opportunity to assess what you have in your portfolio and are you positioned for what's on the other side of the drawdown.
Marta, how are you looking at this? How do you think investors should be positioned, those who are looking to reassess some of their holdings right now?
There's a few things that are top of mind for us and that I think should be top of mind for investors, generally speaking. So one is valuation, what's priced in, and whether you're able to get assets at a better price than their fair value or at a worse price than their fair value. And then the second consideration is that macroeconomic conditions. And we're not going to be right, or very few are going to be right on what the macroeconomic conditions are. Very few of us would have anticipated the war in Ukraine. Very few of us would have anticipated some of the troubles that China is facing now. And so what we have to do is we have to think about these positions and stress test how they might behave in different market environments. And then we also have to be willing to take nibbles over time. So kind of dollar cost average into opportunity. Right now, we don't know how macro conditions are going to develop, but we do know that prices are selling off. And we know that not just low quality stuff is selling off, but also higher quality securities are selling off. We can see that in fixed income with shorter dated bonds offering better yields than they have previously. And we can see that with some of these high quality companies here in the US beginning to sell off. So I wouldn't advocate for people to rush into the market and hashtag buy the dip, but I would advocate for people to look for opportunities and have this idea that as the market sells off, these are good times to reevaluate that shopping list and see what you can, add to your portfolios.
Exactly. Take a look at that shopping list indeed. Thank you so much to our market panel there, Marta Norton, the America's Chief Investment Officer of Morningstar Investment Management, and Brian Jacobsen, Allspring's Global Investment Senior Investment Strategist. Thank you so much.